Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights that'll boost your trading potential. Coming up, the Fed ending its balance sheet runoff, signaling no more rate cuts this year. Former Fed insider and market strategist Danielle DiMartino Booth joins us in just a couple minutes with her insights. She says Powell may be out of step with the wave of layoffs hitting corporate America. We're going to dig into what that means for the markets and the economy. And later, gold shine has dimmed. The precious metal saw its biggest drop since 2020 earlier this week. Is it a healthy pullback or a warning sign of what's ahead? We're going to break down the charts and what traders are watching next. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. We are half an hour into the trading day. We have a down session on a lot of asset classes, including equities, the S&P 500 pulling back. There was a lot in the mix. Clearly, investors still think about what they heard from Jerome Powell and the Fed yesterday afternoon. We have a truce between the United States and China. What does that really boil down to? Investors still digging through that. And some big tech earnings that are, frankly, weighing on the market. It's a bit of a disappointment. Let's jump into the heat map. It'll start telling the story of what is happening beneath the surface. You can see we got Microsoft pulling back, NVIDIA, Google to the upside. I started breaking these down. Microsoft, I'm going to stay on the heat map for this one, down about 2%. Investing in OpenAI reduced its earnings by over $3 billion in the quarter. A lot of spending going into AI, perhaps some concern around that. Let's take a closer look at Alphabet. It is up on the screen more than 5%, a beat on revenue, topping $100 billion in quarterly revenue for the first time. Cloud growth at 34%. So this is one of the rare stocks today that is being rewarded. It is having a healthy gain, as we saw, just more than 5%. But Meta, a drag on the market. Of course, the parent company of Facebook, they actually posted their highest revenue growth since the first quarter of 2024, but there's a few things going on here. One of them is Trump's Big Beautiful Bill Act actually led to a one-time charge of almost $16 billion, but the bigger concern seems to be for Meta shareholders right now. Again, a very big spend on artificial intelligence, trying to get an edge in that industry, and that spend not going away anytime soon. A big drop-off for Meta shares right now. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing education team, and Danielle DiMartino Booth, CEO and Chief Strategist for QI Research, joining us from New York. Great to have you back on the program, or both of you on the program today. It's been years since I spoke with Danielle, but obviously it feels like a bit of a reunion. Just a reminder to our viewers, though, before we dig in, that the views and forecasts expressed are solely those of Danielle and her team at QI Research, and based on that research. Now, Danielle, we did get the cut we were expecting from the Fed yesterday afternoon, but then a pretty strong signal that December may not be a cut. Is Jerome Powell, is the Fed making a mistake leading us down that path?
Well, I think that the headlines that were crossing as Powell was finishing up with his press conference, that is GM laying off 2,900 workers indefinitely. This morning we heard from Estee Lauder. The stock is up today big time because it's going to lay off another 7,000 workers. In the month of October, we've had the second highest tracking of announced layoffs in the last 2 years. So, yes, I think the Fed is either willfully ignoring its employment mandate or truly it's trying to get through the fog. But no, yes, I think the Fed is making a mistake. There's clearly a lot of dissent on that committee.
So you think that perhaps in heading to December, they're not leading us down the right path. They also talked about, it's always, the rate cut gets the headline. Pretty significant, though, that they're going to end the balance sheet runoff in December. How significant is this? Does it raise concerns about liquidity in the system that the Fed would make this move?
Well, I think the Fed is definitely paying close attention to the overnight lending markets and the fact that we have seen some increases in those rates. A similar setup in 2019 kind of forced the Fed's hand. They had to launch what they called at the time not QE, injecting a ton of liquidity in the system to try and stabilize the overnight funding rate. I was actually surprised that they didn't pull the plug on November the 1st and decided to have that go through December the 1st. We will see if they're able to get through this next month without any disruptions.
Danielle, let's go back to Fed Chair Powell. You mentioned, he sounded tone deaf given the recent wave of layoffs you just mentioned, Estee Lauder, GM. Of course, we know some of the tech companies have also started a string of layoffs. He's behind the eight ball with the labor market seemingly more and more fractured. So what's the disconnect between the Fed's message and what's actually happening in the labor market?
Well, if you listen to Powell and what he said that it was very difficult to make monetary policy with the government shut down. And, the odd thing about that is not only has Powell in the past referenced state level unemployment data, he's referenced ADP in the past, but yet he fell back on the fact that the U.S. government is shut down and that therefore they don't have official data in hand in order to be informed in their monetary policy making, and that if that continues through December, that the Fed should slow its pace of easing. But my goodness, you just have to open your eyes, open your ears to see what's happening in the U.S. economy. This is not a nuanced, uncertain message that's being broadcast by one company after another.
Yeah, absolutely. And then, so let's talk about the dual mandate that they have then, Danielle. So we know the CPI print, that was the last data they ingested that officially came out. The guy September. Fairly cool by all accounts. Inflation still remains stubborn and sticky in areas like energy and food, while other parts of the economy do show disinflation. So how did Powell's remarks suggest the Fed is balancing these pressures?
Well, Powell was also doing something fairly unusual for him characteristically yesterday, and that's he was speaking for many members of the committee and expressing their concerns with the potential for inflation to take off, which seemed rather strange because, as you note, the last and only, in fact, since the government shut down, official print that we've had is the CPI, the Consumer Price Index, and that came in appreciably cooler than what was expecting. And to your other point, gasoline prices, food prices, they're extremely problematic, but they're also areas of price pressures over which the Fed has absolutely no control. So I think for them to be leaning and saying there's tension that remains between their two mandates of minimizing inflation and maximizing employment, I think it's fairly disingenuous at this juncture.
Danielle, I wanted to ask you, what's the bigger risk now? Because you said, obviously, there's things that they cannot control. Our central bank in Canada, with their cut yesterday, saying there's things they can't control, and that would be, trade disruptions and trade wars. So you get the rate cut, you get the QT shift. Could they move too early and reignite inflation, or could they stay pat, like you're saying, perhaps not move in December, make a mistake, and deepen financial stress in the States?
That is the likeliest scenario right now. Small businesses are having a lot of trouble borrowing. Rates remain prohibitively high for that sector of the economy that has been shedding jobs for some time. That's what they've indicated in one survey after another. So, if they were to just pause, in December, I do think that would be a mistake. We tend to see these types of moves, even if the Fed's going to pull back, in 3 meetings in a row. And again, there are things that the Fed cannot control for, but boy, we have not seen a lot of fallout from the tariffs. And unlike the Bank of Canada, Chair Powell actually pushed back on whether or not artificial intelligence is affecting monetary policy.
Danielle, now given that we're in the midst of earnings seasons, of course, and there's obviously been a lot of chatter about equity valuations, which are fairly highly valued. You look at the Cape-Shiller ratio; it's leveling areas from back in 1999. Do you think that, given how earnings are unfolding and fairly well so far, and are the financial stability risks aren't really elevated, how should investors really be interpreting this? Is this a reassurance that we have, or is there subtle warnings in here?
Well, it's very difficult to say because valuation is never a timing mechanism for the markets. And as we saw in the 2000 episode, in fact, former Fed Chair Alan Greenspan made his irrational exuberance comments in 1996. And we know that the rally had at least 4 more years to run after those concerns were voiced. The biggest problem here is that momentum is something that is very difficult to get in front of, as is the passive flows into the market that automatically prop up the $5 trillion market cap stock the most. So I think that right now, if you look at what professional investors are doing, it's that they're paying up to be hedged against a potential market disruption. And I think there's something to be said for, if you're long this market, you should have some kind of an insurance policy in the event that there's a major disruption.
Let's get back to Powell for a moment. That's interesting stuff on the markets. Obviously, we know that even though he holds the market's attention right now, the world's attention when it comes to like the Fed decisions, his time is limited. He's going to be done. There's going to be a replacement. We're probably, the word seems to be, Danielle, maybe perhaps you know better than us, so we're not going to get that news anytime soon. This is going to be a lot of political noise. How do you see this playing out?
Well, I think that Treasury Secretary Scott Bessent has said on several occasions now, pretty soon we're going to be announcing the final nominee, and he's pushed that timeline back such that now he's saying he's hoping for Thanksgiving. Well, the way the Senate and every parliament in the world, for that matter, acts is they're going to leave for the holiday break. So there are only 3 weeks that the Senate could conceivably have if Secretary Bessent does not push back on that timeline again, such that I foresee uncertainty on this matter carrying into 2026 easily. President Trump is not an easy person to pin down.
Danielle, let's talk about that a little bit more because we want to talk about the dissidents. We know the FOMC blackout is over. So what will investors most be eager to hear about from the Fed officials now that they can speak again? We know there's two main dissidents coming out of this result with the cut that happened.
So I think what we'll be listening most closely for is signs that there is a majority in one direction or another. There were 7 individuals in the September meeting when they all cast their dots on the dot plot who felt that there should not be another rate cut in 2025 back in September, meaning, was Jeffrey Schmidt of the Kansas City Fed, was he speaking by way of his dissent for the other 6 who felt that there should not be rate cuts? I don't think the markets are going to pay very much attention to Myron. They see him as walking out the door and going back to his job at the White House at the end of January. But as far as other dovish speakers go, we'll be looking to see what the size of their contingency implicitly is, because we're going to be game planning out who's going to dissent at the December meeting and whether or not there's going to be a cut, depending on what these Fed speakers say about who's on my team. I mean, we have baseball on the mind, right?
Yeah, we do.
Exactly. We take all this stuff together, Danielle. There's a lot going on in the markets. You mentioned the fact that if people are long, they might want to take a look at some hedging strategies because you don't know when the irrational exuberance will come to an end and what that timeline is. Are the markets making a lot of sense to you right now? We just think about, I'm taking a look at asset classes today. We've had a big pullback in gold and in silver. A lot of things that have been running. The equities are coming back again today. What's your feeling about this market right now? How do you approach it?
I would have to say you should approach this market very, very carefully because of everything that we know about it. My goodness, there was a huge another debt sale that's being planned in order to finance AI. I feel like it was just 5 hot minutes ago that the only thing we could say about AI was that it was financing itself with free cash flow. That's no longer the case. So the main narrative that is upholding momentum right now, I would say, is very fragile. So this market must be approached carefully just because of what we know about it.
Danielle, always great catching up with you. Hope we can do it again soon.
Likewise. Thank you for having me.
That was Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Hearing lots of interesting stuff in there. Of course, we knew going into this that Danielle was thinking if they don't cut in December, that is going to be a mistake. When she was talking about the markets, and we've been hearing this out there, right? If you are long this market after everything that we've been through, maybe you need to start thinking about some other strategies. That irrational exuberance can last longer than you think, but you don't know when it's going to end.
That's exactly right, Greg. I mean, we talked. She was very beating the drum about like most of these. Investors are looking at hedging strategies at the moment and hedging at the market tops that we find ourselves in. So that's something to be cautious about. We've seen some of the safe haven, demand get peeled or pulled back from the table there. So a lot remains to be seen going into this new year, and more so, the main focus is going to be on December and really what the outcome is there in terms of shaping that monetary policy direction that's going to give it either the equity markets a next leg up or make it stall from where it is right now.
No short of excitement or questions when it comes to this market. If you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. Just open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace, start trading for real. Now, for a more technical take on what's happening in the markets, Hiran, you're taking a closer look at gold. Big question marks around this one.
Yeah, we are. The yellow metal's back in focus again, Greg. We saw that big course correction, which we'll just check in a moment in the charts. But what we are seeing at the moment is two big sort of drivers for gold's prices. One is we have this, on an ongoing U.S. government shutdown, as well as the U.S.-China trade deal announcements. Just happened last night, by the way. Of course, there was reductions across the board. Rare earth supplies are back on the table for the United States for the next year or so, and so that meant that gold's going to contribute. Price consolidation should continue happening over the next 2 to 3 weeks there. Now, one of the big sentiments was there's a framework that's been agreed. This is we just want to see whether this is more kicking the can down the road with the deal, or it's an actual firm deal that's going to be, we'll believe it when there's signatures or pen to paper that's put down on this. That could, and if that doesn't happen, that could revive the demand for safe haven gold being this case. Now, one of the things we also noted was yesterday's remarks from Fed Chair Powell. Gold did retreat based on that news, and whenever you see that coming in and there's expectation that the Fed futures are also trimming expectations on a cut for December, probabilities have dropped down to about 67% now when it was close to 90% prior to that. That would be a net positive for the dollar, but also gold negative as well. So lower interest rate environments, they tend to benefit, gold tends to benefit in a lower interest rate environments, whereas the dollar would run up if they do keep it at pat there. But let's go to the charts and see what that price action is showing here, Greg. So I've just got the yearly chart pulled up. It's a one-day chart, candlesticks that we're looking at. So what we have is we did see this big consolidation, and then we saw into September, we saw this big run up. So 3,500 was a key level of previous resistance, and I've marked it by these areas where we saw rejections coming off of this, but it was just kind of like a coiled spring waiting to get unloaded. And in September, early September, we did see it actually start making big moves up. In fact, we started a new sort of intermediate short bull run over here as marked by this trend line that we had. We hit the peaks just at this 4,400, which marked all-time highs we hit on gold. But then we saw this seismic drop. This is a 6% decline, the biggest in a decade. In fact, this was on the news that had come out in early October about the China and U.S. spat that was going on there. So this is the key. The break of this trend, we never saw it. We saw it tested and bounce off of it, but there was a break in confirmation. And what that means is we saw it break cleanly, but we saw confirmation because we saw it make subsequent follow-up lower lows and higher lows as well. So we know this is a clean break. Now, where it has found some support after the meeting yesterday with FOMC announcement, and then today, or overnight, I should say, a great meeting in South Korea, as Trump put it, we saw gold kind of bouncing a little bit back, just sitting under the 21-day moving average, which is now going to act as immediate overhead resistance over here. It hasn't, I will remark, it's been respecting the 21-day moving average by and large for the entire year up until like May, where it slightly broke down. We do see the break over here. So this is quite a significant move down, and possibly we'll look to see if we can recapture the 21-day and get back up there.
All right, interesting chart work on gold there. You also have one of the chip makers, AMD, in your sights.
I do, yeah. We talked about earnings, and it's there's a plethora of earnings coming up, but namely the chip makers are going to start their rounds fairly in short order. AMD is going to be reporting next week on November the 4th. This is going to be the Q3 earnings. Consensus coming in will be 117 on the EPS, which marks about a 27% year over year increase and 8.7 billion on the top line, marking 28%. The big news with AMD, of course, is the margins they hope to recover their margins from the last quarter. That was they had a decline of almost 53% down to 43%. And this was on the news that the AMI 350 accelerator shipments ramp up is going to happen, which really will highlight robust demand in its AI and core computing segments there. We also knew that there was some big landmark deals that were struck in the last couple of weeks. One with OpenAI, of course. They're going to be supplying the new MI 450 series chips, which will underpin the 1 gigawatt OpenAI build out that they're planning for 2026, and then the deal with Oracle. So going into this earnings print, investors really want to look for a couple of things that they want to get some more details on. The Oracle deal is going to be one of them, data center momentum, especially commentary on their chip ramp, MI 350 and the MI 450 chip that they have, and visibility onto their product launches and the Helios roadmap that they have. So those will be the key things to look at. The risks, of course, is they do still face headwinds from the U.S. export controls. Hopefully, there wasn't too much dialogue coming out of the deal yesterday and what that means for the chips just yet. The advanced chips are still off the table. So AMD, like NVIDIA, has its own chip that it does market to China, MI308. They already took the hit down, so we'll see more on that. But looking at the charts, I'm going to pull up AMD's charts and see what's unfolded here first. So we saw what I'll turn everyone's attention to, first of all, is this big seismic move. So AMD was resisting at this 185 key level for quite a bit of time, never was able to test it. We rejected off of this level in mid-August. We went down, almost forming like a bull flag pattern, in fact. So we saw this big run up. We saw this flag pattern where the prices were declining, and then we saw this big breakout just starting in early October. And this was around the news when they struck deals with Oracle, but this big runaway gap, what we call it, we see big volume pushing up, and we see a new market participants wanted to enter the stock, and so we saw this big gap form where it blasted through both of these support levels that were established prior and started a new run up. It has now actually resumed this trend, so this upper trend that we started forming back in April, it's rejected, it's broken past it and is now acting as its sort of dynamic support. It's been respecting quite a bit. We did see it top at 265. Now, one thing I do want to give caution to is that the candles, when we look at the strength of the bull, or the candles tell us how strong the bullish or bearish sentiment is, Greg. And we're starting to see a little bit of froth at the top at these levels where we're seeing the bodies essentially becoming more and more narrower, which may tell us that momentum is waning. But when I do look for momentum, I do turn to RSI and MACD. The RSI was in the overbought territory, remained there because it was strongly trending. But where you want to see a break is if it pulls back below the 70 and starts heading downward towards the 50, then we know that we could see some profit taking at these levels, of course. MACD is quite squarely still trending, strongly trending upwards, still confirming that we have momentum on our sides here.
All right, here now, as you've done all that great chart work, you're going to walk us through significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Okay, walk us through it here.
Yeah, let's go for it. So let's start with one of the trades you could look at in earnings. It's not necessarily, I would call it bullish, but it is looking to capture volatility that you have when you come into earnings. Given the shape, the technical nature of the price action of how AMD's played out so far, we see like levels where the market has topped potentially. Going into this earnings print, it's almost priced to perfection where is AMD going to really surprise to the upside with so much news that's already come out? So going into this, one strategy you could employ is what we call an iron butterfly. It is a neutral strategy. I'll explain how that exactly works. So this strategy, in fact, spans 4 different option legs. So what we have and the reason why it's called a butterfly is because you have a body over here where we're looking to sell pretty much the at-the-money strike, which as of yesterday when I set this up, which was the 265 strike, both a call and a put for the same expiry date. So we're selling the call at 265 and we're selling the put at 265. Now, whenever we do selling strategies, we don't want to be exposed to outsized moves, of course. So we always, going back to the hedging conversation, we want to hedge our bets. And in this case, the way we're going to do it is we're going to buy a put further down below at the 235 level, which is going to cap our risk on the downside. And then we're going to buy a similar call on the upside at the 295 strike level. Now, what this does is it gives us a 30 wide, spread that we have over here. So the strategy is an income-based strategy. So we're looking to, because we're selling sort of the at the money strikes, we're collecting a bunch of premium here. So in this case, we're collecting approximately about just shy of $20 premium over here on a 30 wide spread. So if we think about the numbers now, what we ideally want to happen, Greg, is we want the stock to remain within the premium that we collect. So we want the stock not to move more than $19, in other words. So you can see on my chart, what I've marked up is this white perforated line where you see these red shaded areas. This is where we start making a loss. So if the stock goes to the upside, and you can see our break even is labeled based on that, if it gets to 284.65 on the upside, we start losing money, and we have our max loss at 295 on the upside. And on the downside, similar, our break-even price is going to be 246.35, marked right here. And so max loss would arise if it fell all the way down to 235 over here. Now, speaking of losses, of course, what does it in fact end up being? So that is going to be the difference between what the spread is, $30 in this case, minus what we collected as a premium, which is just about $19.65, so $19.65, which leaves a difference of $10.35. For a single contract, this would mean $1,035 we would lose if it ends up making those moves.
Okay, interesting there. A neutral strategy with an iron butterfly. What else you got for us?
All right. Let's go to the bearish one. If you have more of a bearish lean, especially if the thesis holds out where we think it's priced to perfection, the news is not as great as it's come out. We knew from Microsoft, we knew from Google that had reported. Google had an outsized one, but Microsoft had a little bit of a shaky start there. So coming into this one, what a trader may consider is doing a debit put spread. So this is a directional trade. We're looking to play the downside movement if there is one. So what I've mapped out is I've looked at this area, which is sort of topping, even with the Bollinger Bands, we're at the upper end of the top over here, and looking to see possibly where the next level could be, where the stock could come. So this next level identified on the technical charts was that big gap that we formed. Gaps tend to get filled in technical charts. So that's an area we want to see, and especially when there's a catalyst that's around the corner, in this case being the earnings. So what you could do is look to buy the kind of at the money strike of the 260 put. So looking to play the downside over here. You could now, any trader can decide how far they want the width to be. The greater the width, the more expensive this trade is going to be, because we're going to be selling a much further out. In this case, we're selling the 200 strike put, which is going to be, and we're giving a little bit more time on our sides, Greg. You notice with the other trade, we were looking to just cap it off during earnings week, but this one we're going further out into December. The reason is we don't want time to work against us. Time decay is a very real thing when you're doing long option strategies. So we want to minimize that effect by going a little bit more longer dated here. And so what this trade is, we're going 60 wide. The trade is going to cost us $18 or $1,800 on a single contract. So what this means is our break-even price is $242, which I've marked over here. What that means is we need the stock to fall, and we need it to fall at least to our break-even price so we can just square up and make back what we spent. But ideally, we want it to really drop as much as down to 200 if we can, to really maximize the profit in this case. And that would be the difference between the difference between the width that we have with the spread, which is $60, minus what we paid. We're hoping to pay $18 for this trade, and that would be $4,200 there.
All right, great chart work as always here, and always fascinating ideas. As always, investors should perform their own due diligence before engaging in trading. So we return on Tuesday here, and we're debating a name that is pretty well known out there. What do we got for the people on Tuesday morning?
We got good old McD's that we're going to be debating. It's the first. We've hummed and hawed about this one for a while, Greg, but we finally put it to. We're going to put it to the test, and we'll see what holds on the other side of Tuesday. Who's going to take the bull and bear on this one?
Will the golden arches sizzle or fizzle? We're looking forward to that one. Another great show today, my friend. And the bear and bull cases all be broken down on that one Tuesday, 10 a.m. Eastern time. Thanks for watching, and we'll see you then.